This is NBR Today. Auckland tailor Murray Crane of bespoke suit store Crane Brothers has been fined $3,000 and ordered to pay a former employee almost $21,000 in unpaid wages and benefits. Jordan Gibson had been hired as creative director of former fashion store Gubbin Mackie, of which Murray Crane is sole director and 90% shareholder. Mr Gibson was given the other 10% of shares in the company, 1949 Limited, with the potential to earn more shares if the business performed. Well, the store did not perform, and Mr Crane sought to change the way Mr Gibson was paid from salary to drawings, which, according to the Employment Relations Authority, failed to abide by the terms of Mr Gibson's employment contract. The ERA rejected Mr Crane's plea that as a shareholder, Mr Gibson should bear the risk of a new venture, saying their relationship was instead one of employer and employee. The Financial Markets Authority says it's concerned by inconsistencies in company audits, despite an improvement in the overall quality of audits in recent years. The market watchdog audits New Zealand's auditors and released an audit quality monitoring report for the year to June 30, in which it evaluated files from 5 of the 19 domestic registered audit firms in New Zealand. FMA Capital Markets Director Garth Stanish says while audits will never be perfect, there are problems, particularly with inconsistencies within individual firms. Mr Stanish told NBR there also needs to be constant vigilance from the audit firms and from the directors of FMC reporting entities.
You know, this is a system. It requires both good auditing, but it also requires that the entity themselves provide good quality financial information to the auditor in the first place. So, you know, it shouldn't be the case that firms are relying on auditors to make a silk's purse out of a sow's ear. They should be providing the auditor with good quality financial information so that independent assurance can then be performed. That shouldn't be the situation where basically the auditors are having to pick through a ton of muck to try to get to the relevant issue.
After noticing the saying cash is king is being bandied around a fair bit in the investment world right now, Shoeshine has been talking to local fund managers to find out if they're holding more cash than usual. The saying is often associated with the times when it's beneficial to have a large chunk of an investment portfolio in defensive cash due to the lack of good value investment opportunities or, of course, falling financial markets. Well, the answer from those Shoeshine spoke to was invariably yes. Pi Funds has cash levels at 35 to 69% depending on the fund, and cash for all funds is at or near its highest point. Key Street's cash weightings are significantly over its benchmarks at the moment, and Milford Asset Management has been edging away from equities. Its active growth, diversified income and balanced funds all have more cash, about 20 to 25% than the usual 5 to 10%. All three say they're erring on the side of caution, given how volatile and risky the markets are looking. The Wall Street sell-off continued this week with heavy losses in technology shares and steep declines in oil prices after concerns of oversupply. Fisher & Paykel Healthcare has reported a 20% rise in net profit for the half year ended September 30 after strong revenue growth across both its hospital and home care product groups. New Zealand's biggest listed healthcare company reported a $97.4 million net profit after tax and operating revenue of $511.3 million, up 12% on the first half of last year. The company will pay an interim dividend of 9.75 cents a share, an increase of 11% on the interim dividend last year, to be paid December 21. Chief Executive Lewis Graydon told NBR the company is on track, with core product groups delivering a 12% increase in revenue or 9% in constant currency terms.
Well, it's a good, strong result, Grant, with a continuation in our hospital business of the trends we've seen over the last few years, and then a pretty good result in home care, assisted by our sleep-style CPAP device growing a robust 43%. One thing we did call out is relatively flat growth in hardware in our hospital business. You know, we think that's customers waiting for our new product more than likely.
Well, control of restaurant brands looks almost certain to shift to Mexico after independent directors and a major shareholder provisionally agreed to accept a partial takeover offer from FinAccess Capital. The fast food franchise operator said today it had entered a pre-bid agreement with the Mexican financial investor over its proposal to buy up to 75% of restaurant brands for $9.45 a share. Restaurant Brands chairman Ted Van Arkel has backed the takeover deal, saying it gave shareholders an opportunity to accelerate the realisation of some of the future value of the shares while retaining a continuing exposure to Restaurant Brands' future performance. As we look ahead to tomorrow, and NBR talks to Cabinet Minister Shane Jones about his spat with the banks and the Provincial Growth Fund. Oh, and about snorkelling in Hawaii. So for that and more, nbr.co.nz. Enjoy your evening.
To unlock your 2 free articles a week, head to nbr.co.nz.